Todd Flavio, Pacific Residential Partners. So we're at that point in the economic cycle where we really get to see what mortgage companies were really thinking and doing 12 months ago. So already this year, we've seen companies unwind, we've seen them go out of business, and we've seen them significantly reduce staff. So here's a few examples. One of the largest wholesale lenders in the U.S. just reduced their staff to 1,000 employees. That is down from 4,000 employees just over a year ago. So even technology companies don't downsize that rapidly typically. We had another medium-sized lender 2 weeks ago that decided to shut down their entire wholesale division on the spot. So what's unusual about that is not that they necessarily decided to not continue with wholesale, which is somewhat common, but what they did do is fire everybody on the spot on a Thursday morning, terminate their entire pipeline, and not honor any client or employee that was a part of the organization or in the pipeline. Another one was Wells Fargo. So say what you will, but despite any negativity over the last 5 to 6 years with them, Wells Fargo has provided more home loans over the last 20 years than any other company. But what they did was they decided to close their correspondent channel. And that is a significant departure from the way that they structure their mortgage business. So again, major change in a major company. We had another small size lender that went out of business earlier this year. Now, those happen and those come and go. But what was crazy about that one is they had to file for bankruptcy because of the way that they managed their warehouse line. And what they did is they tied up so many loans that they could not sell on their warehouse line. And when rates started to increase and the environment changed dramatically, they had no place to stick those loans and to find somebody to purchase that. So they in essence had more dead cap money than the worst NFL team, and it had completely paralyzed their ability to operate. So we're going to continue to see today what companies had planned for a year ago. Some planned prudently, some managed around fixed cost, hedging and volume reductions, and some did not. So when rates are low and volume is heavy, this reminds me of the family that moves into the new house in your neighborhood. The ones with the new cars, the boats, the luxury vacations, and the major remodel, and then they're forced to sell and downsize 2 years later due to changes in the economy and not sustaining their lifestyle. So we're seeing all this play out right now amongst us. So companies are cutting back, they're playing it safe because they're coming off record volume last year, right? No, not at all. So Quicken announced last week that they would honor new loan amounts for 2023. So new loan amounts, that's crazy because Fannie Mae does not announce these until Thanksgiving each year after they carefully analyze economic, income, and demographic data. So Quicken, I give them credit, they made a daring and bold move to accept new loans up to $715,000 for the anticipated conforming limit, despite them not even really knowing what the actual new loan amount will be. And keep in mind, Fannie Mae doesn't even know at this moment what that number will be. So this was announced just after August, and we are just over halfway through the year. So this is daring because of the costs associated with making this kind of bold move. There are hedging costs, there's holding costs, there's warehouse lines being tied up, and a huge risk of selling a product that could erode in value over the next 6 months. So enormous risk and financial pressure, but that's isolated, right? No, not at all. The next day, United Wholesale Mortgage, which is the largest wholesale lender in the U.S., did the same thing. And now we've heard Penny Mac is going to do the same thing, and we're already hearing about other lenders continuing to do this and, again, reacting to what Quicken did. So with volume being down this year significantly, why would companies take on the added risk in financial exposure? What's happening right now is what we call price wars in wholesale mortgage. Companies cannot discount their current price significantly, but what they're doing is they're rolling the dice to gain an edge in product and market share to drive additional volume in the future. It's really a sacrifice in the short term for protecting and increasing their market share. It's a big risk, and in some ways, absolutely crazy, but we are witnessing these price wars right now in mortgage. And in a lot of ways, the same things are playing out on the real estate side where that traditional commission structure is under significant pressure. So these will be two very important things that we continue to keep an eye on for the rest of this year to see how they unfold. So thanks again.